We begin our session to finish on time for the gala dinner organized by the central bank to commence the. My name is Maria Bogomolova, and I'm a partner in the Assurance and Consulting Services of PwC Russia, and our topic today is how we assess the financial stability of insurance companies. And we have a unique possibility to review this issue from various angles. And I will introduce our panelists: Philip Kabunia, Director of Insurance and Market Department of the Bank of Russia; Andrei Savelyev, Director for Finance and Investment, Corporate Governance Directorate of Rezo Garantia; Alexei Bredikhin, Director of the Financial Institution Rating Group of Accra; and Anastasia Vinogradova, Partner in the Head of Insurance and Non-State Pension Funds Advisory Division. In the public space, information about the fact that the central bank has developed and opened up for discussion a new method to assess the financial stability of insurance company was issued in March 2019, and since then there were numerous discussions with the insurers community discussing the details of this new regulation and the time frame of its implementation. There are a lot of questions, starting from why do we need it. We used to have wonderful documents about the margins, about the coverage, and then there are those who say that the document is okay, but there are actual questions about whether the percentage ratios are set right, about whether it's too tight, about debts and there are those who say that everything is done fine, and so there is a whole range of opinions about this document. Hence, my first question is to Philip, and I have two questions actually. The first question: could you elaborate and could you tell us why have you decided to implement this new, to introduce this new regulation, and maybe tell us more about the specific features of your suggestions. Well, dear colleagues, we've discussed it with the market. We had a lot of consultations. What made us introduce this idea in the first place? Well, any growth and any insurance company must be able to perform its liabilities. Over the past few years, we have fewer participants in the market. Starting from 2014, we have fewer players. It's not because of the liabilities. Well, they didn't cope. And in this respect, we see today's regulation as being not optimal. It does not allow us to see the risks. And so we decided for a risk-oriented approach, the one that exists in other markets and in other countries, in other economies, and it has been there for a long time, and our insurance market is lagging behind in a way. Yesterday at a session that was part of the during the battle with Vladimir Viktorovich, they had voting, they had poll, and people were answering, yeah, we need a new approach to assessing, and some said, no, you shouldn't do that because very soon you'll have no insurance companies whatsoever. What does it mean? It was one person who said everything was done right. What have we suggested? I'll just give you some broad idea and then maybe specify certain approaches and details. We suggested three things. First, we suggested let us look at the balances in a general way. We look at liabilities, insurance liabilities, and the assets that allow you or do not allow you to perform these liabilities, and all other liabilities and assets are somehow ignored, or we've ignored them. And a company, an insolvent company, won't be able to perform its liabilities, and the customer doesn't. I mean, it doesn't matter for the customer why it happened, because once a company is bankrupt, the customer suffers. The second thing, we suggested that the assets, some of the assets that are not used as, not accepted as coverage, should be counted as at zero cost. We're talking about shares in companies. Well, these things are not seen as coverage. Anyway, we suggested that real estate objects should be assessed in a different way compared to the way we do it today. And the third thing, we suggested we should introduce a risk factor. The system will start working from the mid-2021, and this risk component that takes into account market risk or credit risk, it will become more and more important during the time until 2025. What does it mean that this regulation will leave no companies whatsoever? It means that today a lot of players, if they look at the balance, they don't have means to perform their liabilities. I think it's too dramatic. Our estimates show that it's not so. If we try some numbers and figures, we looked at the third quarter of the previous year, and a lot has changed in the balance sheets of the companies since then. And not to torture market with new inquiries for calibration, we used the data with specifying parameters for specific companies. Not all ways in which companies can adapt to new conditions. I mean, we could not foresee how companies would adapt to new conditions, so we'll be pretty conservative in our estimates. We see that if we'll look at the year 2025 and apply all regulatory requirements for balance sheets that we have, well, recapitalization sum would sound dreadfully. I won't even pronounce it. What influences this sum? 144 billion. Sum has to do with the risk of with the compensation risk. Deposits are in one and the same commercial bank. Without any losses, without losing on costs, in the year 2020-21 could be solved without recapitalization. Once the deposits, which are usually 1-year deposits, can be distributed between several banks. Well, there are certain things that have to do with the structure of property, and it can be shareholders, or it can be an LTD, or if we place the assets on the balance sheet, and we know that it already happened through certain transactions, it adds up another 100 billion rubles. This is what we see right away. So if we look at the requirements, the capital requirements, equity requirements, and at the obvious steps that can be taken in terms of assets, and suggest that other ways are not possible, and that those shares in the shareholder societies and the LTDs and the real estate objects cannot be re-evaluated or cannot be sold, and we're right in seeing it in a conservative way, then when we calibrated for the companies that take 54% of the payouts, it turned out that recapitalization, the required recapitalization, would make up to 18% by mid-2018, and after that it would grow by 4 or 5% annually, with the shock pressure growing. I'll just remind you that the net revenue, was 165 billion rubles across the whole market. So if we take into account some super crisis, if we don't take into account some super crisis events that can take place, the market can endure it. Well, those, of course, who look at, who do not take into account all their liabilities and would cover their instability, well, they will be in trouble. As for recalibration, and some companies won't need this recapitalization. They would only have to implement certain technical measures. What does this model lacks? This model only looks at assets. We're not talking about equities, and we somehow ease the regulatory pressure. We have a new approach towards the stabilization fund, and we replacing it with a simpler formula. Other nuances are also there. We often have a question that how do we combine the different types of the Solvency II? We've announced Solvency II. It has some additional approaches, and it's more tough. The key parameters are calibration and taking into account all the transition periods and taking all scenario risks. We end up with an 90th percentile. Why don't we do that right now? But we strategically see ourselves moving towards our companies becoming more stable, or no less stable than the European ones, because it's too expensive. It's very expensive, and the calculations we are pressured by the events that took place in our economy in 2014, 2015, and since we now have a completely different monetary policy, and it influences macroeconomy. So through recalibration of the risks, we'll have a better outcome and an opportunity to answer the requirements. I'm not saying we'll manage to do that by 2025, but still, there were a lot of suggestions from the market. It's not and we agreed to them because we saw them as sensible ones. So we are balancing between theoretical good and the practice, because the price for additional, in some cases, the price for additional stability was too high for certain businesses, like in medical insurance, or I think that in such cases, most of the companies who provide those types of insurances are able to adapt. Thank you very much. I think you've answered an additional questions, the questions we could have later from the audience. So we know what regulators think. Now we'd like to ask those that are regulated. Could you share what do you think about the regulations to be introduced?
Спасибо.
Maria, well, thank you. Well, it's an interesting word. Yeah, it's like, when you're being observed, but as long as you're not being experimented on. I can't tell you for the whole market, because there are different companies, and the balance, from the insurance companies, they're very different. So, but talking about companies with excessive equity, it's a revolutionary step in regulation. Because what we had before, the situation with the insurance balance and the ignoring what we're supposed to be doing, it just didn't match any kind of logic. So when I saw this project, I was very pleased that it was very logically unifying the elements of quality control of the equity quality and the credit risk, and all of it was wrapped on the formula of the calculation of the real capital. Is there an alternative to what's offered to a platform? In my opinion, no, there isn't, because you cannot offer anything better. How many revolutionaries would live to the day when the revolution prevails? I think enough for the market not to die, but their number is going to go down. And maybe that's the part of healthy regulation, because the number of companies in the market today, we can argue whether it's excessive or not, but where's the negative here? The result of implementation of this, we're going to end up with a more sustainable sector. Where are the negatives? Definitely. Without this regulation, it's going to make the insurers maintain the majority of their efforts as equity. So the numbers, then the volumes of equity is going to grow, and that's part of the task of the regulator. Which means that the revenue per equity are going to go down, simply because the denominator is going to grow, which is going to hit the growth. So strengthening of the regulation makes the system more sustainable, but slows the growth, or carries the risks of slowing the growth. And all of us are going to have to live with this. And plus there's going to be concentration, because I can only imagine that a certain share of the players that today have their equities, they have, the money set aside for tax or different, lots of land lots in interesting regions, they can have difficulties. And the mergers and acquisitions are going to speed up at the insurance markets, which I think is good. So the platform, or the regulation platform, I think is great. There are nuances. There are three important ones, and the concentration, in my opinion, is not a nuance, because I think it's, you cannot keep the 90% of your balance in one bank or one reinsurer. It is not a logical thing to do. Let's look where we can get the important things for the entire sector, and we need to discuss something here and change something here, because the regulator right now is holding up a position in terms of debit debt, because with the retailers, the subrogatory and the debit debt consists of hundreds of thousands of millions of small dispersed units. So the small companies use actuarial methods for them. So right now the regulator suggests approaching in a way that all overdue debitory debt goes away, even though statistically some of it comes back, but the mathematically calculated part comes back, and the entire debitory debt without that doesn't exceed 10 business days is also excluded. I would suggest switching to the actuary method of the debitory and subrogatory evaluation so that the regulator knows that the actuary methods are adequate to include the annual calculations and support of these indices in the report of the responsible actuary. So if the actuary trusts to count the reserve, and that's the concept that's accepted right now, it would be logical to suppose that the regulator would entrust the responsible actuary with with confirming the reserves for the debitory budget. For the market, it's a very important question because as an agency companies and the companies that work through brokers or other insurance mediators, all of us have debt on insurance mediators, and some of us have debt on insurers. I'm not talking about like ridiculous cases when it's 1 year of debt, but up to 3 months in general are normal in the market. And I think this needs additional discussion with the market. Next up, the amount of the required capital. And here we abandon our direct topic. The instruction that both Philip was talking about is the calculation of how much equity there actually is. And then we start comparing it and how much it should be. Definitely, everybody acknowledges that the stability reserve in the current form is very outdated, and my colleagues would agree that you know it's believed that this is something you know that should have stayed in the yesterday. However, we talk about to some sort of a risk premium. We haven't seen how it's being prepared, but as a suggestion or as a direction of thought maybe, I could offer the following. Let's take two identical insurance companies. They write the same business. You know, one company writes it to 0, and I mean technically the technical result is 0, and the other one gives 20% plus. Which one has the reserve to cover the insurance should be bigger? It's on the surface. I'm telling you how much. I'm not telling you how much more, but the regulator should punish with capital every company that writes their business into 0 because it's a strange business. Whereas the company who demonstrates a large margin and have the operational reserve should have less equity. It's not a know-how. It's just a very common logic. So I hope when the formulas are going to come out, we're going to be able to see something like this. And the last comment I had, fairly complex, though generally known formulas have been used to calculate the credit risk and calculate miscellaneous risks. They're very clear formulas. There's an intuitive feeling that when we start applying them to practice, there will be fine-tuning questions, not the global ones, but the fine-tuning coefficients is probably going to have to get moved. Otherwise, the formulas are going to get strange results, which is a normal process, and I'm sure we are going to approach it in 2021 and 2022. Thank you. Andrei, thank you. I wanted to ask Alexei a question. I'm making an educated guess that the more equity the insurer has, the happier the rating agency. Is that correct? It is. Are there any additions to what Andrei said? Oh, yes, I have some ideas. But first, let me tell you, there are very positive ones. The shift from one regimen to another, I think it's a great one. But we have to we can't copy what's happening because Russian conditions, European conditions, they're different. It's been mentioned that 99.5% it remains a dream or something we can't even dream today because it's just out of our reach. And it's not the problem of the, currency fluctuation or the shares fluctuations, but there's a different costs of equity, whether we count it at 10 to 15%, or in Europe it's 4 to 5%. So it's a 3-time difference. Even if our risk coefficients have been on the European level, our equity still costs 3 times more. So just from the economic viewpoint, there is no point to take down the defaulting levels I think is still going to cost less than the cost of the equity. So this must be taken into account and ultimately has to be accounted for. Another thing we didn't see in the system, there's no difference between the demand for the small and big systematic companies, even though the losses, if they default of this or that company, are going to be disproportional. If they were just proportional to the number of assets, that difference shouldn't be there. But the whole idea of the systematic meaning, it says there is an outside effect apart from direct losses when a company defaults that can be counted as a number of assets. There are additional ones, and the economical losses incurred, they keep growing. So we think this should be thought through. Shouldn't we introduce a difference in terms of the market demand for the systematic players and non-systematic players? Now the huge question is how many systematic players are we going to count as them, because our insurance market is not particularly big. It's not comparable to the banks, maybe nobody. But that decision has to be fully thought through. The third point is about the approach that the regulator just prescribes to exclude certain assets from the balance sheets. Not directly, but don't count them as equity as full. And that is a very rigid demand. It doesn't exist in the European regulation. It can be explained. Our reality is today we cannot check the quality of all assets, so it's desired that the business model for the insurance are so simple and so transparent that are easy to count. That's great on one hand. But on the other hand, it's an additional limitation that lowers the efficiency of insurance activity. And what Andrei was talking about here about the debt. There's also subordinate obligations that are believed to be a bad asset. I think it's wrong because it's normal market tool. It can have a rating that should be evaluated, and the rating for the subordinated debt is lower. But we shouldn't exclude it entirely. That's an additional burden. Because if we look at the non-insurance activity, sure, there are reasons to exclude it because it's not going to affect. But what it comes to like normal insurance activity, I think we have to be very careful. And fourth and last, it's more technical thing that have to do with the structure of the formula. The credit risk already has been mentioned. On the one hand, the approach is very complex. On the other hand, it's not without some problems associated with it, because we believe we need to think more about the correlation between the defaults that when we do Monte Carlo according to these rules, every default considered independent. It's not exactly true. And ultimately, the last thing what's been said today, that the model concerns only the risks that have to do with the assets. But the part of the margin that's calculated according to the old rules, it remains. But that is a very rough estimate, but it's an estimate of the insurer's risk, or at least the parameters that are being used. So these are the insurance parameters. And it is here where you just, put them together, and it turns out that, what's being ignored, that those risks are not correlated. And because of that, many insurers have the higher demand, what is economically justified. So can we go back to this formula and maybe somehow keep that correlation in mind, even if ever so slightly? But I think in essence it's everything what I wanted to say.
Well, thank you, Alexei. I'd like to ask Philip to give a brief comment about the suggestions presented. Well, in terms of the suggestions you're ready to comment on. Well, I probably won't be able to do it briefly, but I'll try to generalize. As for the nuances, especially, well, I'll generalize about correlation of all risks. It seemed to me that the approach we provided, I think we mitigated it all. Look at what happens to risks during crisis or correction, market correction. There's correlation is nearly one. It's an interesting discussion. The correlation works towards one. And we could have a discussion about the parameters. As for us adding pressure and burden that has to do with risks, we'll try to go away from it when we start to introduce solvency, to see how insurance risks are assessed. Maybe it will lead to the majority of companies will have lower estimates for their reserves, and there will be correction. And since we spent 10 rounds discussing this little bit, and if we keep discussing it, we'll never move on. And if we pour it out to the market right away, I think it will be difficult to digest. So I'm not going into details in terms of how we calculate, and when we start the discussion of how we calculate. And I call the market, assess yourselves. And we have an Excel file. You can use your own software for calculations. I strongly advise you not to wait until this regulation comes to force. We'll be writing the manual and the legal manual for it. Do estimate it now, do assess it now, and see how it works with you. So we do encourage you to do it as soon as possible. As for calibration of risks, one figure for you to understand the scope of changes. I'm not even talking about the cost of capital. One can have different views, but 90% percentile change with 90% quintile, 28 billion. Let's take 5 more percent. We have 84. So there's twofold growth. It is obvious for us that we can't move along this road because of the humps that we see emerging. Our customers, on the other hand, I mean, they live in our economy, in the economy that suffers the risks we have. And we need to be ready to look for the optimum solution in view of our realities without targeting European risks. Because we will have to work in this country with our risks, with our features. And last thing about proportionality and the system of values. This approach does not influence the systemic value of Micros effects. It's a solo story which aims at company performing its liabilities for the customers. Well, the customers buy insurance service. They don't. It's not important for them whether it's systemically important. And the pressure, both for small and large companies, with the same approach. I mean, it should be there. I mean, with the same approach to assets. So though the discussion about systemic, value and importance of companies and additional requirements, maybe this discussion should take place. But in this case, we'll limit ourselves. Thank you, Philip. Solvency II in Europe has been introduced in 2016. And SW 18, the standard that ICO 18 for insurance agreements comes to force on January the 1st, 2020. And for the Europeans, there's a dilemma. How do you link the principles that exist in Solvency II with what's going to happen with ICO 18? The way ICO requires you to assess your insurance reserves, according to some European insurers, will enhance the burden on capital. Russia is in a privileged position in this respect. If central bank has an ability to is able to introduce Solvency II from 2022. It means we introduced both the ICO 18 and Solvency II on January the 1st, 2022. How does ICO 18 will influence the pressure on capital for the insurers? Well, indeed, Maria has rightfully emphasized that the way ICO 18 will influence the insurer's balance makes for additional pressure, burden on the capital. I don't want to go deep into the solvency concept. I'd like to draw a parallel with the way ICO 18 can work with a concept that has been voiced by the central bank, because I guess this is more important for us as a topic. It's been said here several times today that financial stability of an insurer in terms of its balance is based on the assets and liabilities ratio. ILM and asset liability management is the basis for risk management in the organization. And when for many years we've had a situation when insurance company assets would gradually, within the MCFO framework, would be differently assessed, will be assessed, and their assessment would shift towards the real cost. This is one of the goals why ICO 18 has actually appeared. It is meant to bridge the gap. In fact, however, in the current standards we have do not always lead to liabilities and insurance reserves will have a fair assessment on the balance sheet. And to achieve this fair assessment, we need to do a lot of tests and calculations. Why this unfair or invalid estimate might be seen? You have to pay for the losses. I mean, sometimes you sign an agreement with zero or negative profit. You have to take into account. As for the risk, stabilization or the risk adjustment, it will replace the stabilization reserve that is meant to ensure the amount of reserve, the necessary amount of reserve. It is assessed in reference to the losses, and in economical sense, it means that if an insurance company wants to buy a portfolio with reserves from another insurance company, there's a probability that once rights and liabilities are transferred to another company, it forms an additional risk adjustment. It is a payment for a risk that may emerge in the future. And this is how this additional component is formed. If we compare it to the current 557, 558 MP instructions, these recalculation with risk adjustment replacing the stabilization reserve, it can give an added value, but a lot depends on the profile of the company, of the types of insurances it does. But it is not necessarily so. The next important component is reserving the profit margin. ISO 17 is based on the money flow. The mathematical reserve for life insurance is divided into the risk reserve and profit. Of the unexpired risk reserve and profit. Your balance shows you the profit from the existing portfolio, from the working portfolio. But the catch is that once you put this profit into your profits and losses report, it might not refer to your proportional RNP and to the way your profits are reflected in regards to the life insurance agreements. How do we avoid it, and how do we get to the most efficient capital and resource management? Well, we have to prepare ourselves for ICO 17 and to calculate the effects on balance correctly. You need to have a detailed estimation and assessment and understand how your company's capital will be influenced. Secondly, since the regulator is still thinking how to implement the new methodology of assessing insurance reserves, one might find it reasonable to use the methodology suggested by ICO 17 and the manuals provided by the Monetary Association. International community estimates the costs of the implementation of ICO 17 pretty high, at a pretty high level. And since the insurers will have to alter their business processes, their information systems, and they will also suffer operational and various other types of costs, we could also profit from this alteration and use the processes that are already built around MSFO 17, supporting the methodology for regulatory reserves. So I would suggest we bring these two methodologies together as closely as possible and see how they, what kind of influence they have. Do they add extra burden on capital? Perform tests, analyze various accounting methods and accounting practices, and see how it will be reflected in your insurance reserves. I'd also like to support my colleagues, especially Alexei, when he was talking about the correlation of risks. Indeed, a concept of risk assessment has been voiced, and the stress scenario that we apply to assets. But if we're talking about assessing risks for capital, we need to apply the stress scenario and take into account risks correlation. Otherwise, many companies would lack the effect of the compensation effect, and will have a wrong assessment of the way it influences the capital. Well, basically, this is it. If you have questions, I'm ready to take them.
Thank you. I'll just make a small note. A couple days ago, the Bank of Russia published a project on the standard of accounting PS18. It's just the correlation of risks. I wanted to give my reaction. There's lots of risks we take into account, and those we don't take into account as well. Which don't we take? The stresses of the insurance. That the mortality rate changes or the losses go into the stratosphere. That we don't take that. What do we keep in mind if we talk about the correlation of the risk we take into account for both sides of the balance sheet? And here we made we play in terms of both the interest rate and the currency. Here we just broadcast the correlation between the currency obligation and the stress that is put in terms of the stress, because it's happening with the interest risk. And I also suggested we change the approach to this part. So we think that our model here is actually quite balanced, and this compensations that are happening, they've already been fulfilled. What is not present, because the approach itself, that every risk is calculated separately on various directions, and take the effect that has worse effect on the equity. If we use the classical approach with just one scenario, that given some big open position, if there's a shock, then we can get positive effect per equity. But this approach, we're confident it's more correct in this case, and it's more conservative. But on the other hand, since we cannot predict the possible shock 100%, the balance happens on the parameters, so some certain risks in one direction they play stronger than in others. But we think it's a good approach, and it can be calculated on the correlation level that they can be more correct. We are ready to analyze them. Thank you. Everything we've been discussing in terms of Solvency II concept, it's the first pillar. There are two more pillars that we can't discuss here, but there is one question about the Solvency II, is the system of corporate management. I wanted to ask Andrei. Philip, while explaining that the regulation that is planned to implement, it leads the current approaches to the approaches that exist in bank regulation. There's an opinion, and I would like to know where you stand on this, that the risk management level with the banks is higher than the level that exists with the insurance companies. And question, do you exist, and the demand, is it going to improve the risk management in the insurance companies or not? Thank you. In literature, we have a famous character, Ivan Krylov, and he authored the first system of corporate management. You know what that system was? There are 4 musicians that are trying to get seated in different ways, thinking that it's going to improve their orchestra. I worked in various systems of corporate management, in the wild Russian one, prior to 1996, and then to the crazy EBR one, and then a very interesting in a bank one, and now in risk. And I have my own vision. The success or lack thereof for the insurance company does not depend on the system of corporate management. It depends on the musicians. If the musicians don't know how to play or play a negative game, because that happens in the financial market, in the banking market, and even, unfortunately, even in the insurance, it already started, that no system of corporate management can stop them if they have non-positive intent. And if they don't have them, then it's not going to help them. There will be a lot of papers, bureaucracy, it's protocol. All of this is going to get filed and it's going to be written, but it's not going to help the patient. Because I used to think, if you can formalize something, if you can force the musicians to be better, where there aren't any better musicians, then of course you say, well, each musician needs to have an MBA. And so what? There's lots of people with MBAs that can't do much, and there's people without MBAs that do a great job. So unfortunately, there is no formal criteria, or at least it is unbeknownst to me, that would help separate bad management from good management, and that's what we're talking about. So, I guess, I love regulation based on balance because it's unbiased. There's audit, and it's clear how company lives and how it makes money. Corporate management is subjective by definition. And if it can be avoided, I would call upon everybody to avoid it altogether. Now, if we talk about the second question that Maria brushed upon, the quality of risk management compared to banks. I worked in both. I can tell you for sure. The largest insurers have the quality management, have far better quality there. Do you know a lot of banks that have on their books, don't have credit risks that go over 90 to 100 million rubles, which is normal for insurance? No, there's banks don't exist, maybe 1.5 that do retail credit. The insurance have far better system of accepting risks, the actuary estimation and passing them on through insurance. If we talk about big normal insurance companies, banks don't have it, or it's impossible. And because of this, the level of drop in the banks is far higher than in the insurance sphere. And it doesn't mean that everything is great and everything can be improved. But I think these are just very different stories in terms of the fundamental quality. Andrei, thank you. I believe getting an estimate from you, it makes. I love the insurance, and it was nice to hear. I'd love to continue talking to the panelists, but I don't want to deprive the audience from a chance to ask a question. Do we have any questions in the app? We do not. Can we pass the microphone to whoever wants to ask a question? See, I don't understand a lot in balance management, but I do in projects. Andrei, I want to argue with you. Am I correct in my understanding that this lack of acceptance of corporate management is similar to what some believe, that enlightened monarchy is better than democracy? Because I think the problem of corporate government is called upon to lower the risks of wrong decision-making by one person that can affect the way that company is going to go. Sure, when CEO decisions are undermined by tens of committees is pointless, and it's bound for a poor ending. But do you think is there a rightful balance for the freedom of will made by the managers of companies and the limitations in terms of committees and the boards and so on?
Thank you, Vladimir. Well, let's take certain wrapper points. Authoritarianism in business is not evil. Authoritarianism in business is a norm. All startups in Russia, in the US, in Europe, and Russia is a huge startup. I mean, we haven't had anything in 25 years. It has been created by people with alpha genes, with leadership qualities. This is how our country works. So when we're talking about saying that let's do it all in a democratic way, it fundamentally opposes the way the Russian business is built and is working. I mean, we have to take it as it is. It is widely known that Russian business culture and insurance or banking sector are not an exception. It is characterized by high or super high level of interpersonal relations. If you come to a Western corporation, there are procedures, there are rules. In Russia, it's all more finely tuned, and we all understand. In each company, there's a certain and different, unique model of behavior. We know there are companies, we're not naming names, where the founder is still de facto is a CEO, is a business leader. It's bad. I mean, why? Why would it? Well, let us make him take a board and doesn't committees. Nothing will change. There are companies other very good companies that are managed by committees. And we're talking about top five. Without a committee, no decision is made. Well, it works for them. And I encourage we should not regulate the process. We do not tell the supplier of insurance. So we have someone selling full comprehensive insurance. We don't make him read out a disclaimer. Everything that I'm saying to you can always be true or can always be untrue. Should not always be a lie. I mean, we're not going to do that. We're not going to do that. So my attitude is we should not regulate the process. We should regulate the result of the process, the outcome. I think we are falling into extremes: monarchy, authoritarianism, democracy. Well, you can take regulation to extremes, prescribing, how many seconds should one take when taking a floor in a committee. On the other hand, I mean, financial market is licensed. It's not by chance it is being regulated, and certain things that seem self-evident that have to do with corporate process. For example, one should assess the risks, but not everybody does it. And I would disagree with you. I would agree that we should not put tight regulation on the process, but certain things should happen, and you should have a certain stand towards these things when you're making some major decisions, when you invest, or when you you need to listen to someone who would inform you of the risks your business might face. And, well, you might take an authoritarian decision. For example, signing a document once you've been told that it's going to be risky. But still, this is, if legislator gives us this authority, we're going to introduce certain things. But I'm talking here about risk management and internal control measures. Western philosophy is rooted in the practices when a regulator comes to a company, assessing the psychological conditions, the emotional state, making it part of the study of the corporate situation. We probably don't need it, or we might not need it at all, but still, this basic requirements, like brushing your teeth in the morning. I think we should introduce such things. I know for sure. I know several examples where the reason that led to bad financial outcomes had to do with a total mess in the management system of the company. And it was reflected in the balance, and it could have been prevented. And I'm sure the majority sitting here, you find these things obvious or self-evident. I wanted to support the argument that when a one person-based company is good, but balance is a post-mortem. Assessing a process is the right thing without waiting for a post-mortem, and European experience and American experience tell us that. Last year we had a quantitative assessment of the management quality and risk management quality. Are you satisfied with the analysis? In your opinion, how should the market be changed? And you've definitely modeled how should the market shift once you introduce the regulation? How should it be recapitalized, etc. As for the quantitative assessment, I've already spoken about those. For the companies that we've calibrated, taking into account transition periods, and we've treated it pretty conservatively, and maybe 18% of the capital by the year 2021 and up to 25. will grow by 4 or 5%. And I hope we'll have another calibration together with the business community specifying for transition periods. As for the studies with corporate management, sometimes we saw that survey was somehow overlooked, or sometimes companies would admit that they lack something. So within our monitoring framework, we can tell you that the situation differs. With the dilemma we're facing, we're still searching for an answer to a question whether we should interfere regulatory. It's a complex issue. Sometimes we probably shouldn't interfere. Sometimes we reduce the competitive field, and today we're asking ourselves, where is that minimum we should stop at? Good afternoon. Could you tell us about shareholders' assessment? How do insurance companies' shareholders see this regulation of corporate management? I mean, it is their authority to have a stand. You have open companies. In our case, shareholders for insurance companies are not public. Maybe we don't need this kind of interference like they do, because, I mean, there are people who are overlooking that. Well, it's a matter, I mean, it's a terminology issue. What do we treat as corporate management? I don't know if we're having tomorrow a session on corporate management in general terms. The board of directors, what kind of authority they have, would suggest it should be treated as a separate issue that is applicable to all public companies, public and not public companies. By corporate management, we need some minor things, smaller things, like set up like principles in the law. We're talking about risk management and internal control or monitoring systems. Well, these stories, apart from internal audit, which is an instrument applied by the shareholder, everything that has to do with risk management system and control systems, it's a matter of company being viable and whether company is able to insure its liabilities. And in this respect and in this part, and the Western experience of practices also shows us that we can regulate it, and it is a second pillar for solvency that Marina has been talking about. And this is the road we're going to take, but it will be transparent. We'll discuss it with the market participants when discussing in general the issues of financial stability. I have two questions, if you allow. The first one, financial stability is good for the market in general, and Andrei has said that will definitely come to the concentration of business. Hence the question, how will this concentration correlate with competition, and how will concentration correlate with the accessibility of insurance services? And my second question is to Alexei. I can see a couple of colleagues in the room. We've been to a financial markets event where we heard a statement from an expert agency that insurance market, despite the fact that it's growing and developing, does not answer the social demand and the public demand. And it wasn't, it was uncomfortable to hear that. Maybe you will explain what does it mean to answer to the demands. Maybe it has to do with the first question of the business concentration. How many of us should exist in the market? And what should the scope of insurance services be? And this social adequacy, what does it depend on? Well, maybe Andre will comment on that, on the first question. Speaking of concentration, well, dear colleagues, it's all very simple. When you have strict requirements on capital, or requirements on capital are becoming more strict, if you don't have revenues, your the market will look for the ways to grow the revenues. The only way you can accumulate, the only way you can grow the numerator, you raise the costs, or you lower the costs, and for the coming 10 years, the situation will be very similar to that we have in Europe and in the US. Concentration. Companies will merge. Some companies will leave the market, will become bankrupt. I'm thinking of smaller companies. And the number of players will reduce. And the players who are going to stay in the market, they're the companies that tried IPO, the profitability should be 18–20%. So if the insurance company cannot insure this this amount of return on assets, unless they can do it, unless they can do it, their services will be more expensive. Our market is concentrated enough because the strongest win. The competition is not between major and smaller companies. It is competition between major companies. So the top 5 or top 10 or top 20. This is where you have competition. The companies below are only niche stories, and they don't have a global influence on the customers. So nothing wrong with the number of players being reduced. I don't see it as something dramatic.
Yesterday, in the future logistics excursion, we talked about, the insurance is math. So when you're little, it's hard to address. So in this sense, I think the fact, even if we didn't change the capital, it still would have happened. But the concentration of business on major players is still happening. And it's not because of the demands, but the competition is out there. And it's strong competition. So we see how among major players, especially on the voluntary insurance markets, there's some very interesting tendencies happening there. So I'm afraid that given the size of our market, I think the consolidation is going to continue happening. But I find it quite possible that there may be some disruptors who are going to push away some of the more established players. But I do not see any contradiction in the consolidation of the market and the fact that the competition should disappear. I think that even to a degree, the quality of this competition may change because the industry is becoming more transparent and more sustainable but because of what we're discussing. But if you would let me, I want to talk about concentration first, but I think it's a very sad tendency, the growth of concentration. And it doesn't have to do, indeed, there's a dual effect here. Because first of all, there's an advantage that the big companies have. It's, the scaling effect or whatever you want to call it. But at the same time, when small companies that have to compete with the big ones. It stimulates the market. They can be more efficient in terms of offering new products that are closer to the consumer. And our small market, cannot stimulate because here we talk about more like retaining the share rather than getting a new one. So, in my opinion, what would be perfect is having both, big players and small ones that do the same thing but from different size. So the small regional companies, they're closer to the particular customers and they create the added value that maybe not interesting enough for major players because it's too small. But when it comes to the second question, it is fairly unexpected because to say that the state task, it contradicts. Because if I understood correctly, what we're talking about the product, the insurance of the borrowers. Because I think the problem has to do, and maybe it's not even an insurer's problem, but the bank's problem, because we see a huge commissions in this segment. So, it's 75%. It's optimistic, but see, the consumer pays for what? That the 75% of the money goes into making a contract, but it's absurd. And I think it's a problem. It's a risk for the market. It can be a risk for the banks, for the insurers, for the regulator. I think we have to address this issue. That's what I suspect what was being said, but not in general. I think the insurance market is. I wanted to develop it as much as possible to, to compare the banking sector and the insurance sector in Russia. It's absurd. It goes towards the banks. No other economy doesn't have this imbalance. Why is the insurance so suppressed? It's a huge question, and it's been asked so many times, the last couple of days, but we never got an answer. But we hope there will be movement. Interesting that all the additional questions that have been asked after the session weren't about the financial sustainability, but the corporate management. Dear colleagues, our time is out. Thanks for your attention. Thanks for your time. And I hope it was interesting. And everybody enjoy your evening.